The broadcast is now starting. All attendees are in listen-only mode.
Good morning. We hope this finds you all safe and healthy. Welcome to the second webinar in our series to provide content from our client conference, which was originally scheduled for today and tomorrow and has been postponed until next year. My name is John Schaefer, and I'm the CEO of AAM and today's moderator. Our presenter today is Chris Lowe, Chief Economist of FHN Financial. Chris has been the featured speaker at our client conference for many years now and has received excellent reviews and a near cult-like following for his presentations at our client conference. We are delighted to have him join us today. A couple of administrative details before we start. Turning to the next page, you are in listen-only mode. Questions are encouraged, and in order to ask questions, please use the question function associated with GoToWebinar. This session is being recorded, and the replay will be distributed after the fact, likely later today. With that, it is my pleasure to turn this over to Chris Lowe. Chris?
John, thank you so much. Thank you, everyone, for joining us today. And I must say it is a real pleasure to be here. The only thing that would be better is if I could actually be there. It's been a long time since I've been to Chicago, and I understand it's just beautiful today. We're talking about the economic outlook, and obviously the outlook right now is dominated by the pandemic. It is a long road back to normal, and we start with data series that I think has been just fantastically useful since this pandemic began. The New York Fed very rapidly developed a weekly economic index. This is very high frequency data. The blue line charts some of the history, including the global financial crisis and Great Recession back in 08-09. The index includes same-store sales, sentiment, unemployment claims, temp staffing, withholding tax payments, and so forth. And more importantly, the fit is actually fantastic. And you can see the red line up there is the year-on-year change in GDP. The blue line is the weekly economic index. The worst miss over this entire period is 2 percentage points. And obviously, when we're talking about the possibility of a truly massive, probably biggest ever quarterly decline in GDP, that's close enough, frankly, to being just about spot on. In the first quarter, the WEI predicted that GDP would be down 0.6%. Again, that's year on year, and the actual turned out to be 0.3%. We saw that updated with no revision this morning. It translates to a 5% quarter-on-quarter drop. So here's what we've got. 12 of 13 weeks of data. That 12th week is going to be revised this afternoon and again next Tuesday. So that one's preliminary. The first 11, which shows this, what looks at the moment like V-shaped recovery, is all pretty solid. Not a whole lot of revision to go into that from here. The average at the moment is down 10%, and that corresponds with a drop in GDP of maybe 30% or so annualized in the quarter. So I do think there is downside risk here. One of the things the WEI is missing, if you look at that list of the components, is it's missing big pieces of the service economy. The reason they're missing is because you're not going to find data that improve the fit in the history, because, well, that service economy mostly just motored along without interruption, even in recessions historically. Obviously, that's not the case now. Social distancing means that industries we thought were recession-proof are not. And just to pick on one group, one example of that is big layoffs in the legal profession, big layoffs in medical services, and so forth. So I think this probably understates the damage a bit, but the two really key takeaways: one, it's not really V-shaped, because almost all of the drop was in just 1 week in early April. And obviously the recovery is taking place over a couple of months. Two, that while we have bounced at a very rapid pace off the bottom, there's still a heck of a long way to go. And three, that we are looking at the worst quarter ever. When we think about the likely recovery path, I think it's useful to think about what GDP's likely to do compared to the financial crisis. It took 3.5 years for the economy to recover after the 08-09 recession. That recession started very slowly. You can see in 08, we actually almost got back to that fourth quarter 2007 peak before plunging in the fourth quarter of 2008 and first quarter of 2009. That big decline in 2 quarters is when most of the housing infrastructure in the economy was washed out. That's what created the hysteresis that caused the recession to be long and the recovery to be slow. Hysteresis is simply a sticky high unemployment rate. And it happens when you wipe out industries, because it means that millions of people have to retrain before they can get back into the job market. It also means that you have to wait around for the economy to create new jobs in new industries to reabsorb all those people, even after they do get training. I think we're looking at a similar situation now. There will be hysteresis in this current crisis, and that's why if you look at the path of recovery, it's very rapid in the beginning. Again, that's consistent with what we've already seen in the WEI, the weekly economic index. That's your reopening. You slow to a still brisk, but not as brisk pace through 2021. And then after that, go back to a growth rate that's similar to the growth rate in the last expansion. And that means an awful lot of people still looking for work. Risks to the outlook. I would say, you know, there's the obvious risks. There's an election this year. The two parties are proposing very different strategies for stimulus, for taxes, for the deficit, and even for dealing with the pandemic. But I think even taking it to a higher level and just looking at where the growth has to come from, this chart shows the change in major GDP sector over that first 2 trillion of the recovery. And I apologize. I wrote first 6 quarters of recovery. That's actually the first 10 quarters. It's 2.5 years to get back to that level. And about 90% of the growth is coming from consumers. That is tremendous reliance on one, consumers' ability to spend. Do people have the jobs and income to support that kind of growth? Two, consumer sentiment. We've already seen sentiment rattled in just the last week because of a resurgence of COVID cases. Three, there are tremendous savings, as I'll show you in a couple of slides, but that savings is going to be needed and will be eked out over months. And the question is it enough to last to keep that spending going? So why is consumption dominating the picture so much? Well, one reason is the drop in consumption is already behind us. The recovery is already beginning. So as we look ahead, there's no more negative quarters to bring into play. That's not true, for example, of business fixed investment, where structured spending especially, I expect will decline for the next year. Always lags. We've got considerable overbuilding, oversupply in commercial real estate especially, and that's going to take time to work through. Foreign trade, same story. We saw numbers this morning for May that were just awful. Imports actually fell. Trade deficit widened by $6 billion because exports fell to an 11-year low. Exports are going to recover some at some point, but again, that's behind what's going on in consumption. So in both of those key sectors, there's a big negative still coming in the future data that'll be reflected in third quarter GDP. There's also big changes in spending patterns that imply big changes, possibly lasting changes in employment. I picked one particular example to illustrate this. What you're looking at here is spending at grocery stores and liquor stores. That's the blue bar. And then the red is spending at restaurants and bars. Each of these months is compared to February 2020. So that's why February, both of these show 0. But what I want to bring your attention to is that 8-month period leading up to February with the blue, well, the bluish box around it. There was almost no change in spending at food consumed at home, drink to, and out. We also, for the first time in U.S. history, had an absolute balance between money spent on eating at home and money spent on eating out. In February, basically $130 billion spent, equally divided by between these two groups. And then, of course, you've got the lockdown, and you see the huge drop-off in spending in restaurants and bars in March and April. You see the partial, but very much partial rebound in May. You see the increase in spending at grocery and liquor stores in blue. And hopefully part of what stands out in this chart is how much bigger those red bars are than the blue bars. Turns out it's a lot cheaper to prepare your own food and drink. And collectively, Americans saved $50 billion in just these two categories alone. There's also $400 billion in savings from the decline in travel spending. The recovery in employment, this chart is built to reflect the recovery in GDP up above. And the first thing that should stand out when you look at this chart is this recovery is a lot less impressive than the one in GDP. You can see the 2.5 million jobs recovered in May. I've got even more coming in June and July combined. That's the end of the lockdown. But after that, a period with no job growth at all for some time, followed by modest job growth from there. The fact is, companies are still very much focused on cost controls, very much focused on margins, and we're just not going to see the kind of rapid job growth, job growth keeping up with GDP growth. We will see some big productivity growth. This is a good opportunity before going on to talk about what it implies for the unemployment rate for any questions. John, do we have any questions yet?
Yes, two questions, one of which dealt with the consumers, and I believe you answered that one. So I'll go on to the second question. When will the employment numbers on page 9 recover to the pre-pandemic levels of employment? How long will it take for that to play out?
Our estimate is that's going to take 7 years. It'll be somewhere between 5 and 10 years. And that's consistent with what we're seeing in the Fed's forecast as well. It takes a remarkably long time. And again, I think it's based on several things. One, that we see in both the weekly and the monthly data that the very rapid progress you make in recovery in the first month or two is not going to carry forward. You're not going to be able to keep that pace going after that. And we've seen that in countries that reopened way ahead of us as well. The other is that there is ongoing productivity growth in the U.S. that margins have been really terribly squeezed, and that companies are focused on controlling those. And then finally, that historically, and this is going back to the 1960s, you just don't see growth in employment or in GDP that's sustained at a more rapid pace than in prior expansions. You can have an absolutely fantastic 1 or 2 quarters up at the beginning, and the deeper the decline, the better those quarters are going to be. But once you get past that, sustained growth just isn't going to be as fast as it was in the prior expansion. And so when we look at the unemployment rate, the peak in the global financial crisis was 10% even. That came after the recession ended, which is normal. It's pretty rare that you get any job growth at all when a recession ends. We are going to break that this time. In fact, the unemployment rate has already begun to drop, although I would point out the Bureau of Labor Statistics has had a really difficult time with its own employees misclassifying people. The official peak in the unemployment rate in this recession stands at 14.7% in April, but 14.8. But the BLS says that if they had, in fact, classified people properly, it would have been 19.8%. They don't ever plan to fix that, but that is the true peak in unemployment. That's what we're coming back from. In the meantime, they've given remedial training to their employees, so we may actually see a pop in the unemployment rate next month because they expect they will classify people correctly. who are unemployed. But I think that the path in this chart is roughly what we expect. That unemployment rate will drop down to roughly 10% at the end of this year. And then from there, the pace of improvement is going to be similar to what we saw from 2010 to 2017. It's going to be painfully slow. And that's because there are industries that just aren't going to be as big as they were before. One that sort of jumps out as the obvious example is leisure and hospitality. Leisure and hospitality contributed the most job gains of any industry in May, 1.2 million. And that brought us back to levels of employment last seen in 1993. This sector is going to recover more, but there have been bankruptcies, there have been restructurings, that people are not going to have the money to travel, even if they're willing to, and there's still months to go before people feel safe, before we even possibly have a vaccine. And so there will be more financial strain in the sector. I think you're going to see permanent job losses in this sector that are far bigger than the ones in the global financial crisis, when we lost about 1.5 million jobs on a permanent basis. This time, I think it's more like 3 to 5 million. The other big employer that we're watching for job losses, there actually aren't very many yet, just a few 100,000, is state and local municipalities. Their tax base has been pummeled. They're going to have to make cuts, and those cuts will come as those municipalities and states work on their next budgets, at which point hopefully they'll have a rough idea of how much tax revenue recovers. We've looked at forecasts from quite a few international elements, and one of them is the OECD, the Organization for Economic Cooperation and Development. Theirs is perhaps the most pessimistic of these big forecasts, although the IMF released a new, much uglier forecast yesterday, not to be outdone. And what you see in these forecasts is sort of two consistent themes. One, this is the worst recession globally since the 1930s. You also see a reminder that the baseline forecast is not necessarily the best case. The OECD expects that there will be a second wave. That is their baseline. The Fed's forecast for the U.S., the IMF forecast for the world is that that there is just one major hit to the economy from COVID. Their secondary forecast is that W-shaped pattern. But either way, what I think this chart makes eminently clear is best case or worst case, we have lost a tremendous amount of potential GDP out to the end of 2021. They're showing a 6 percentage point gap between where GDP should be and where GDP is because of this pandemic. A 6 percentage point gap that could in fact be 10 percentage points if there is a second hit of the virus at the end of this year or early next year. The global nature of this recession is essentially unprecedented. I mean, yes, the Great Depression was a global phenomenon, but it's hard to compare when 90% of the data we use are series that don't go back into the 1930s. It's also unusual because it's a recession that hit the service sector first and harder. Recessions always begin in the goods producing sector. It's always manufacturing first, then construction, then services, until this one. And this one, it is services, and they were absolutely walloped. This is a purchasing management composite index for the world. It's put together by JP Morgan and Market, and the index in the global financial crisis fell to about 37. This time around, it fell to 25.5. It is right now at 35. In other words, below where it was at the financial crisis low. We don't yet have the May numbers. I'm sorry, the June numbers for this. I expect it'll climb well up into that GFC recession range. In other words, much improved in June, but still below 50. Any reading below 50 indicates a contraction. So still ongoing weakness. And again, to just illustrate the remarkable nature of the international situation, these are estimates from the OECD for individual country and region growth rates. I put a little green box around the US so you can find it. Two things that jump out from this chart. The damage to economies is determined by two variables. The first, how hard did COVID hit? The US was hit harder than anybody else on a national basis, although if you take New York out of the mix, it's more like, call it the 80th percentile. But it's clearly not the weakest economy. And the reason is that we had the most aggressive response by fiscal and monetary authorities of anywhere in the world. If you look at the far left side of the chart, you see Spain, France, and Italy with the very worst economic performance, followed by the UK. They were hit hard by COVID, but they also were hit hard by the lack of fiscal response. The European authorities are still arguing over whether to stimulate their economies. Germany has done some stimulus domestically, but the rest of Europe, much of the rest anyway, can't afford it. The UK has responded to, but it's weak beer compared to what we've done in the US. And then on the far right side, Indonesia, China, Korea, it's remarkable now because we all watched what happened in China in February and March, but China's hit from the virus was actually very small compared to ours or Europe's. And because of that, even though their policy response has been weaker, the economic damage is significantly less. Global trade is tumbling, and this is the important point when we think about the U.S. economy, when we think about investing in the U.S., when we think about our own investment decisions. It doesn't necessarily matter what's going on in the rest of the world until it hits global trade. And back in 08 and 09, the global financial crisis caused an absolutely catastrophic collapse in global trade volumes, which hurt American companies badly. Those with big export exposure were badly damaged by that drop. The trade data lagged a bit. We just got the May numbers for U.S. goods. As I mentioned earlier, they were just awful. And it supports our estimate, which is based on some of the biggest countries which have already reported that the trade volume is going to collapse in May and June. And I think will take a very long time to recover. Switching gears a little bit, the single most asked questions by my clients this year has been about money supply. You're all probably aware that Fed stimulus has been fairly aggressive. They were much quicker to act than they were in the financial crisis. They opened a whole alphabet soup of programs within just weeks. In fact, to their credit, before there was any data showing weakness, they made the decision to aggressively buy assets, open up all kinds of emergency lending, interfere aggressively in financial markets based on market data and anecdotal information. And by the way, I think they deserve enormous credit because, of course, since then, we have economic data that supports the fact that it was the right decision. Money supply growth is off the charts. I did a weekly on this a few weeks back. At the time, it was the most rapid money supply growth. This is the change against a year ago. It was the most rapid since 1943. What happened in 1943 is that the U.S. Flooded the economy with cash to support the war effort while arming in front of D-Day. This is now, because we've got another couple of weeks of data, actually even faster money supply growth than that. The money supply data has been reconstructed back to 1900. There is nothing comparable to the pace of money supply growth in the last several weeks. Now, I threw inflation up on this chart as well. That's the blue line down at the bottom. You can see there was a time in the 70s and 80s when it correlated. I absolutely took this data apart in another weekly a few weeks ago, where we did everything we could to model it. We broke it into 10-year chunks, 5-year chunks, changed the lag times, and so forth. You just cannot find a correlation for that period from 1980 through 2010. It just doesn't fit. And so I certainly would not worry about a rise in money supply growth causing inflation unless you can find other data, other evidence to support it. So let's dive a little bit deeper. Where the heck is all that money? So these are all the components of M1 and M2, with the exception of one, the dashed line up there. That's institutional money funds. It used to go into M3. The Fed doesn't calculate M3 anymore, so it's not really part of money supply anymore. But you can see where the money's going, right? Start with the obvious one, the one that declined, the gray bar down at the bottom, the gray line. That's CDs, that's small time deposits, and nobody wants a CD when interest rates are this low. So that's not where it's gone. Money market mutual funds not picking up much either. That's the light blue line down at the bottom. And currency in circulation growing actually at a very rapid pace compared to history, but nothing like the growth in the big three. The big three are institutional money funds, up about $1 trillion. Demand and other checkable deposits, that's checking accounts and other accounts you can write checks against, are up by about $1 trillion as well. And then savings deposits are up more than 1.4 trillion. Few things to point out on this chart. One of them is that they're all starting to plateau. The rapid growth in money supply was in March, and it was in April. Second thing to point out, very clear correlation between the buildup in institutional money funds and one, huge surge in corporate borrowing at the very beginning of the pandemic, mostly big corporations drawing down existing credit lines. Why? Because the first lesson of the global financial crisis was you can't trust banks to be there in a recession, because of course banks weren't there the last time around. The other correlation is with PPP loans. So this is cash that was paid out by the government. And you see that also coming into those demand and savings deposits. I think a big part of this then is the stimulus money from the government. And actually, I think this is a good time to pause again, John, and ask if you've got any further questions that come in.
Thanks, Chris. Yes, there was one question that came in regarding money and money supply. How is money created, and how confident are you that there's going to be no long-term impact on inflation from this rapid increase in the money supply?
Terrific question. And let's start with the creation side. There's two ways money is this money, two sources for it. One of it was direct payments from the government. The government is borrowing in the treasury market, and they're turning around and lending or giving that money in many cases to companies, to individuals in the form of extended unemployment benefits and direct checks to households. And that money lands in these components that go into money supply, checking accounts, savings accounts, and so forth. Now, normally, the flip side of that is somebody's out there buying those treasuries, but that somebody is to a large extent the Federal Reserve, and the Fed is funding those purchases with reserves. Reserves are not included in money supply. So you can see in the data that normally where money comes from, and this is why I think the Fed has been criticized in some quarters as being too aggressive, as being too generous, as pumping up money supply and creating a potential disaster inflation scenario down the road, because normally money growth comes from the Fed lowering interest rates, making borrowing attractive, and people borrow. But look at what's going on with consumers. This is consumer credit outstanding, fastest decline and biggest decline in the history of the data series. This is mostly credit card debt that's falling, but auto lending is down, and student lending is down as well. Those were the three biggest growth categories through the last expansion. So it's not households borrowing because rates are suddenly attractive. And then when you look at corporate debt, there has been tremendous issuance of corporate bonds, and partly that is the Fed's responsibility. That their pledge to buy corporate debt collapsed corporate credit spreads, which made it possible for corporations to borrow more. And partly it's lower interest rates as well. But the biggest run up in corporate borrowing was again drawing down these C&I lines, and this was before the Fed made it cheaper to borrow. These are rates that were established historically. This is to a large part cash that companies don't need yet. The reason they drew those lines down is because they wanted to be sure to get the money while it was still available. They were pretty much panicked about the possibility that if they were in a financial pinch down the road, they wouldn't be able to access credit. So it's an even split then between money coming from Congress and money coming from credit, part of which reflects Fed rate cuts, Fed loan programs, but most of which is a result of the CARES Act. In terms of inflation, I'm not worried about it. And the reason I'm not worried about it is that we know from GDP, which is going to be down 30% or so this quarter and will take years to recover. GDP is equal to income. It's as much a measure of the ability and desire to spend as anything else. You just don't have people buying as much goods and services as they were before. And in the meantime, if you think about everything the Fed has done, everything the federal government has done to help the economy, the primary purpose is to keep companies on their feet and to keep jobs available. And obviously, it wasn't perfect. Companies are going bankrupt. Particularly, I think you'll see just an awful lot of small businesses, including restaurants, will never reopen. But they have preserved enough that, and this is true globally, that there is just a tremendous amount of excess capacity. In other words, the ability to produce far exceeds demand, and that is a recipe for deflation, not inflation. Fed's balance sheet, I was surprised to learn, shrank in June. This is the latest data. You can see the tremendous run up in March and April. In May, the pace of purchases of mostly purchases of treasuries slowed. MBS purchases did not slow as much. They are still very aggressively buying mortgages. Repo volumes declined, and other asset growth slowed. And the result is that the Fed's balance sheet did not grow. One of the rare miscommunications by the Fed this year was a few weeks ago when they announced that rather than limiting purchases to companies that could verify their creditworthiness, which is what the CARES Act laid out. The CARES Act allows the Fed to buy corporate bonds that are verified to be creditworthy, not in trouble, and so forth, and also allows them to buy ETFs. And in establishing the right to buy ETFs, the law says if a bond is in an index, the Fed can buy it. The implication being that way they can buy indices, index funds. But what the Fed did was it created an index that includes the entire universe of investment grade debt under 5 years, and that alleviates them from having to verify creditworthiness. Anyway, when they made the announcement they were doing that, it was misinterpreted by people to think that the Fed was announcing that it was actually going to start ramping up its corporate bond purchases. As Jay Powell explained in the Senate, a week later. That was not the intended communication. They just wanted people to know if they need to, they can buy. In the meantime, when you look at the asset side of the Fed's balance sheet, you see that, well, there's been a lot of press about these loan programs, about all these new facilities, including PPP and Main Street lending and so forth. There's been press about central bank liquidity swaps. The vast majority, more than $2 trillion in increases in the Fed's balance sheet, are security purchases. This is old-fashioned, very similar to, well, old-fashioned in the sense of so 10 years ago, basically QE. All the other stuff, I think, was just brilliant communication in the sense that the Fed has managed to significantly tighten spreads, restore liquidity, restore market functionality with very, very little effort on their part. The other side of the balance sheet, of course, liabilities and capital, is how the Fed pays for all this stuff. And you can see the U.S. Treasury has deposited a tremendous amount of cash at the Fed. That's mostly in the general account, and it includes money that is intended to be levered up into all those lending programs, of which only a tiny fraction has been used. There's another $1 trillion+ increase in reserves, a modest increase in currency, and a modest increase in deposits. That explains most of it. The rest, when you compare mid-June to the end of February, really hasn't changed by very much. The Fed has cut the funds rate to what they call the effective lower bound. That is, the rate is being targeted between 0 and 25 basis points. At the June meeting, they published their new summary of economic projections, included in that is a new dot plot, which shows that not a single FOMC member expects to raise rates this year or next year, and only 2 out of 17 expect to raise rates in 2022. That's essentially a pledge to keep rates on hold for 2 years, well, 2.5 in fact. And I think, in fact, they'll be on hold for a lot longer than that. More important even than this communication is the communication about the ongoing policy review, which has emphasized Powell's repeated embracing of the low unemployment, full employment environment in the last 3 years of the expansion, the lack of inflation during that time, the fact that for the really one of the rare, very rare periods in the last 50 years, the U.S. managed to close the gap of income inequality because the economy was at full employment, and an absolute commitment to get back to that as soon as possible. Unfortunately, it's going to take years. And I think we're again, I expect we're not back to full employment for 7 years. I think that's basically when you can expect the Fed to raise rates. It'll be that long. In the meantime, the Fed is helping the economy in other ways. I mentioned spreads earlier. That's investment grade spreads down on the bottom of this chart, high yield spreads on the top, high yield on the right, investment grade on the left. High yield spreads are still pretty wide at 500 over Treasury 10 years. That's close to the peak of 600 in the global financial crisis. Investment grade spreads quite a bit lower. And my sense is that the Fed's happy enough where they are. They're not going to work aggressively to tighten these spreads further. Their stated goal is for markets should be functional. Companies should have access to liquidity. There should be credit for those who need it, but risk should be appropriately priced. And this is the risk they're talking about, obviously not the stock market. That stock market is, well, take a look for yourself, almost back to pre-COVID highs. The news in the last week of this apparent second wave of cases, and I say apparent because believe me, the deeper you dig into the data, the more confusing it gets. The case numbers nationally are very clearly rising. Hospitalization and death rates are not. In individual states, there are some. Arizona, Texas stand out as clearly getting worse. Florida, the case numbers are clearly rising, and we know they're rising even past the increase in testing. But ICU and hospital and death rates are not rising, and so forth. It really is confusing. But I think the key from a stock market perspective, from an economic perspective, is it's ugly enough to inspire caution. People are pulling back. We're seeing the economy beginning to slow already in high-frequency data. And I think it's going to be a lot of that back and forth over the next 6 months at least, until we have news about a vaccine. Stage 3 testing is underway next month. Of the first of about 10 vaccines that are being developed. I expect we will have a vaccine by early next year. I'm hopeful it will work. The early results are very encouraging, but something like 9 out of 10 drugs that pass through phase 1 testing ultimately end up rejected by the time phase 3 is done. Inflation dropped more in March and April than it has in any 2 months ever. I expect you're going to see some bouncing around from here. It's not going to continue to drop forever. But I do think we will see at least a few months where core inflation tracks below zero for a while. And again, I understand we've got booming money supply. There's a lot of cash. But there's also good reason for people to stretch that cash over a long period of time. There will be millions unemployed for months. And I'm not alone in thinking that. This is the latest CPI forwards from the market. What we did was we're taking TIPS data, we're taking Treasury yield data, we're backing out the inflation component, and then by comparing one contract to the next, we build a stack of inflation forwards by year. And you can see market over the next decade doesn't think we're ever going to have the kind of inflation that would support a return to 2% core PCE. It's just not going to happen. That implies a very easy Fed for years, which is our forecast. We're not fighting the market on this one. So just to summarize, at the moment, the majority of the charts we have in hand are showing V-shaped recoveries, but that is very much in the short run. I think the New York Fed WEI index, the weekly economic index, has been the one to follow because it preceded all of the recoveries we've seen now in employment and retail sales and PMIs and others. But that recovery pace is going to fade soon. It's going to be very difficult to replace that last 5 to 10 million jobs, which, by the way, is about what we lost in the global financial crisis. The government has preserved capacity here and globally. Government of France, for example, is working right now on legislation to allow them to pay the salaries of furloughed workers for 2 years. The purpose is to preserve companies and preserve jobs. That is preserving capacity. You add that to cautious spending, it means globally inflation's going to be low for years. Recent rise in case rates keeps consumers cautious, and certainly I think the risk of second and third waves and the effect that has on sentiment is the biggest risk. It's noteworthy, though, that that's not the biggest risk. In recent surveys of investors, they put the election in the top spot. It has big implications, of course, for stimulus, taxes, and regulation. The other big risk is unrest. This is a summer of discontent. There are some very angry people out there. The will to make change is strong. The resources to make change are depleted. And to me, what that means is that the anger is likely to simmer for a very, very long time. With that, John, are there any final questions that have come in?
Thanks, Chris. Yes, actually, a number of questions have come in, and in the interest of time, I'm going to limit it to two, and I apologize to those of you who asked questions that we're not going to be able to get to. But first question, in a worst case scenario, second wave or worse, slow or no vaccine, how bad can the economy get? What would your worst case GDP forecast be?
That's a terrific question, John. And I think, clearly the worst case is no vaccine. And so let's consider that. Then we would very likely see waves of the virus. I don't think GDP falls more than it already has. In other words, the second quarter is going to be the worst, but of course, a failure to recover as much as expected in June is a second quarter impact. So, conceivably, the Atlanta Fed's got GDP down about 50% at an annual rate. It's not going to be that bad, but you could make a case it could be 35 or 40. And then what happens in the worst case scenario is the recovery is very sluggish, and there are many millions unemployed for a very long time.
Okay, thanks. And the last question, there's talk in Washington about a fourth fiscal package. What do you think that might look like, and what will its impact be?
I'm going to go out on a limb and say there will be no fiscal package until after the election. I think we saw that strategy from the Senate Democrats in the police reform bill. They're not allowing debate, effectively putting off police reform until after the election because they think they can get a bill they will like more and their constituents will like more when they, as they expect, gain control of the Senate. I think the same is true of stimulus. White House is going to send Mnuchin to try and negotiate a settlement between the two parties. But I think Republican senators at this point see that as too much of an election risk, and they're going to instead choose to negotiate on their own. And I don't think they're going to reach a compromise on this one, in part, again, because Democrats likely think they can get a bill their constituents will like more if they wait. And on top of that, it boosts Democrat chances in the election if no progress is made on those two issues.
Okay, well, with that, let me thank you. Chris, if we were in Chicago at our client conference, you'd be enjoying an extended round of applause from those who are listening in. Obviously, that's not possible in a video conference environment, but thank you again very, very much. Just as a reminder, we have 2 upcoming webinars, one on July 21st, and you'll be getting within the next week or 2 a notice for that. We encourage you to tune in. As well, on August 27th, we'll have another webinar that will feature the political analyst Scott Rasmussen, the poller, and that will be interesting as we are focusing more and more on the election late summer into the early fall. So again, Chris, thank you, and thank you to all of you for attending. We appreciate it. Have a great day. Goodbye.